Hi, my name is Jordan and welcome to the channel. So 2022 didn't really start off with a big bang. We had the Russian and Ukraine situation, Bitcoin is crashing, Terra Luna went down negative 99%, inflation is going at an all-time high, and the stock market is also going down. I'm not sure about you guys, but to me it seems like when the economy is doing good, our salary doesn't grow with it. But when the economy goes south, some of us might start getting pay cuts, we might lose our jobs due to retrenchment or downsizing. And this is something that can happen very soon depending on how the economy handles itself in the next couple of months. But on the flip side of things, having a mini downturn like this is a good opportunity for us to get some good buys, but do not take my word for it because I'm just a random dude on the internet doing YouTube videos and my portfolio has been tanking as well, so maybe I'm not the best person to follow. But if you do appreciate the honesty and the content that is being put up, do me a solid by hitting the like button and subscribe if you haven't. So today, let's talk about creating a solid portfolio that can potentially weather stormy times and during the good times give you a positive upside as well. But before we go forward, please do not take this as financial advice because I'm not a qualified financial advisor and I cannot give financial advice, but I do hope that you can use the material here to give you a starting point in your research for financial freedom. The strategy we are going to discuss today will only require you to hold 3 investment instruments and at the same time should be able to weather you through stormy days and at the same time give you growth when it's in a bull market. So if you look at the past history, the average bull market is 973 days or roughly 3 years with an average recession that lasts between 8 to 18 months, depending on the severity of the situation. Therefore, what we want to have is to have this portfolio that enables us to be safe during the bear market, and during the bull market, we are able to take some profits if we want to. So the portfolio in question today is the 3-fund portfolio. The 3-fund portfolio works on the basis of having 3 different types of funds or ETF depending on which one you want to go for. Like personal finance, this will vary between individuals, so what I pick might be very different from what you would like. So this should be a reference point for you guys and you don't have to do exactly the same. So the 3-fund portfolio was created by John Bogle, who's the founder of Vanguard. And this isn't a Vanguard that you buy in Dota 2 that gives you life regen and defense, but they're a fund manager that created the biggest funds and the ETF in the world that is known by many. So these funds include the popular ones like VU, VIT, VT and VIC. So John Bogle realized that many people felt intimidated when it comes to investing because of the myriad of choices in the market, and sometimes as human beings, we tend to overcomplicate things by creating our own ETF, which might end up losing us our hard-earned money instead of growing it. So he came up with the concept of the 3-fund portfolio that anyone can set up themselves easily with no frills, and all you need is to have a broker to start. So the concept of the 3-fund portfolio that Bogle came up with will consist of a US index fund, an international index fund, and a US bond market fund. But because almost 30% of you guys who are watching my videos are from Singapore, and to make it easy, we can invest in something like a global index fund, a domestic index fund, and a bond. So depending on where you are from watching this video, these funds or ETF can be swapped to your own liking, but I'll go through 2 different versions so everybody will feel happy. And the benefit of this portfolio is the ability to keep things simple because we are not picking individual companies and hoping that they will do well, but we are only holding on to 3 funds or 3 different ETFs. These 3 funds or ETF will give us a good enough diversification across different investment products and different markets. So in the event our domestic ETF fails, we have the international one that will probably save our portfolio. And if the stock market goes down, we have a bond ETF that can help us tide over these tough times. The 3-fund portfolio is also easy to rebalance because everything is in a percentage and we can move and switch things as and when we like it. So for example, we can do a 40% international ETF, 40% domestic, and 20% bond. Or we can switch it out with 50% international, 20% domestic, and 30% bond, depending on the type of risk that you like. But there is one thing that we have to look out for when setting up our 3-fund portfolio, and that is the expense ratio. And because most funds or ETF do have expense ratios refers to the administrative fees and operating expenses, and this can range between 0.05% all the way to 0.2% depending on the ETF or the fund, and some can go even higher. And needless to say, the lower the expense ratio, the better it is. So to set up our 3-fund portfolio, we know the 3 ingredients that we need, which is an international fund or ETF, domestic fund or ETF, and a bond product. For the viewers in Singapore, an international ETF to consider can be something like VIT. VIT is a total stock market index fund that tracks the performance of CRSP US Total Market Index. So it comes with a 0.03% expense ratio, which is low and pretty good. VIT consists of 4,112 different stocks And the top 10 holdings include Apple, Microsoft, Alphabet, Amazon, Tesla, Berkshire Hathaway, United Health Group, Johnson & Johnson, Meta Platforms, and Nvidia. The top 10 holdings account for 24% of the fund, which means that it's pretty tech heavy, but it's still manageable. But if VIT isn't your cup of tea, VU is also a good ETF to have or to consider. So one of the main differences between VIT and VU is that VIT contains small, medium and large cap companies, while VU only contains the large cap companies, which is in the top 5 companies in the US. And VU consists of 505 different stocks, and the top 10 holdings are the same with VIT, but instead of accounting for 24% of the ETF like VIT, the top 10 holdings in VU accounts for 29% of the ETF. VU also comes with an expense ratio of 0.03%, which is very much the same as VIT. For my friends in the US, these two ETF will fall under your domestic ETF, and your version of the international ETF will be something like VSUX, which tracks the FTSE Global All Cap excluding US index. This will give you exposure to all the other markets in the world except the US. So this ETF comes with an expense ratio of 0.07%, which is pretty alright, though a little bit higher than VIT. So VSUX consists of 7,881 different stocks, with the top 10 holdings consisting of brands like Taiwan Semiconductor, Nestle, Samsung, Tencent, Roche, ASML, Toyota, AstraZeneca, Shell, and Novartis. And the top 10 holdings for VSUX account for 9.4% of the ETF. So that covers the international ETF for my fellow Singaporeans, and both the international and the domestic for the US viewers. So the next part here is to have a domestic ETF for my fellow Singaporeans. So for the US viewers, we've got you covered with VIT and VU for domestic and VSUX for international ETF. But if you're curious about what Singapore market has, this is what we have. So in Singapore, we have the SGX or the Singapore Exchange. We don't have a lot of movement on a daily basis, which means that this is good stability if you're investing into the local market in Singapore. So SGX has two domestic ETFs, which are both named STI ETF, but they are managed by different fund managers. So the first one we have is SPDR STI ETF with the ticker symbol ES3. And the second one is the Nikko AM Singapore STI ETF with the ticker G3B. So both these ETF tracks the STI or the Straits Times Index and are very similar in nature except for the following differences. ES3 is managed by State Street Global Advisors Singapore, and G3B is managed by Nikko Asset Management Asia Limited. So both these fund managers are highly reputable and very stable. ES3 was listed in Singapore back in April 2002, and G3B was listed back in February 2009. So both of these ETFs, they have long track records and have been around for more than 10 years. And if fund size is something you're worried about, ES3 has a larger fund size of $1.7 billion as compared to G3B, which has a fund size of roughly $613 million. But one of the last differences to take note between these two ETFs is the dividend payout. Both ES3 and G3B pays a dividend on a semi-annual basis. ES3 pays a dividend of about 2.5% and G3B pays a dividend of roughly 3%. So these numbers do change depending on the ETF price, and the difference in the dividends is also because of the price of the ETF. And because the price difference between these two ETFs is roughly 5 cents. So let's talk about both of these ETFs and what they hold. So both these ETFs contain the top 30 performing companies in Singapore. So this includes DBS, OCBC, UOB, Jardine Matheson, Singtel, Ascendus, CapitaLand, SGX, Keppel Corp, Hong Kong Land. And the top 10 holdings account for almost 70% of the ETF and is very heavy on the financial sectors because Singapore is a financial hub. But for us locals, purchasing this ETF is a no-brainer because chances are we are already familiar with these companies within the ETF. So lastly, let's talk about bonds. So when the stock market dips, usually the bonds interest rate will go up, which benefits us if we are holding onto bonds. And basically a bond is an IOU or a contract that states what the lender has provided to the borrower, on which date, and when they have to return the funds with an indicated interest rate or a coupon rate. So for the Singapore viewers, we have two main options here, which is the Singapore Savings Bond and A35, which is traded on the SGX. So depending on your risk appetite here, it will determine which you will go for. So Singapore Savings Bond is offered monthly by the Singapore government and backed by them as well on the capital that you put in. So Singapore Savings Bond currently give an interest rate of roughly 2.5% over a 10-year period if you hold on to maturity, and the interest is paid semi-annually. However, the interest works in a ladder fashion where you get lesser interest in the first few years, but as you work towards the maturity age, you'll get more interest. So there are two main benefits of Singapore Savings Bond, which is the low cost at only $500 to start with the bond, and there is no penalty if you have to redeem the bond early. And A35 on the other hand is a bond ETF that tracks the multiple bonds including Singapore government bonds. So this might sound very similar, but something to note with this ETF is that there will be price movement and your capital is not guaranteed. So A35 pays a 2.35% dividend annually, but it comes with the risk of the price movement. Thus, technically you could make some capital gains if the price of the bond starts moving up, and you will make losses if the price of the bond starts going down. For the US friends, we know that the corporate bonds pays a higher return, but it also comes with higher risks that not many of us might want to take. But depending on how you want to set up your 3 ETF portfolio, you can consider the following bonds ETF. There is BND, which tracks the total bond market. We have VGIT for intermediate term bonds and VGLT for long-term bonds. I'm not an expert with the bond market in the US, but based on some articles that I've read, this seems to be the 3 most popular ones. So at this point of time, if you're still watching the video, thank you guys so much because this is a very long video due to the topic being very in-depth. So we're at the final steps of making our own portfolio, which is deciding the allocation. So there are many different ways to do this. It can be a 80-20 allocation where you have 80% in equities and 20% in bonds, or a 70-30 for people who are more risk averse. But if you're really afraid of risk, some people do a 60-40 as well. But you have to know that there'll be less upside when the market moves upwards. So something to keep in mind is that we can always rebalance this portfolio as and when needed to suit our lifestyle because things will change as we progress in life. I hope that this video has given you some insights on potential portfolios that you can set up for yourself or even for your loved ones. And I'll really appreciate it if you can drop a like for the YouTube algorithm, subscribe if you enjoy such content, turn on the notifications to get notified when I post a new video, and I'll see you in the next one.